Welcome back to the IEA's podcast, Everything Energy. I'm Dan Hewitt. Today, oil markets. Oil markets shape our world, from global politics to the price of our weekly shop. When conflicts erupt or trade tensions rise, oil prices can be the first to move. And when oil prices go up, inflation can follow. And that's one of the reasons the recent crisis in the Middle East has caught the world's attention. Over the past decade, global supply and demand patterns have started to shift. Trade flows are still evolving. So what are the forces shaping oil markets today? How resilient could it be to tensions in the Middle East and elsewhere? And what might the oil market look like in the years ahead? Here to help me unpack some of these big themes and discuss the IEA's recent report, Oil 2025, is Toril Bosoni, the IEA's Head of Oil Industry and Markets Division. Toril, thanks for joining us. Before we start, it's worth saying that we're recording on Friday, 27th of June, and there's been a rapidly developing situation involving Israel and Iran recently, so it's possible the situation could have changed by the time you listen to this. But we thought it's nonetheless a useful time to discuss some of the trends underlying today's oil market. So to begin with, perhaps you could give us a big picture of what you're looking for when you're assessing the state of the world's oil markets.
When we're looking at the oil markets today, we're obviously looking at the global economic outlook. We're looking at oil demand, supply, inventories, prices, and trade flows. We're looking at geopolitical events and situations in oil-producing countries and political policy developments and how they will impact oil market fundamentals in the short and medium term.
And maybe you could just tell us a bit about how geopolitical stability, how does that impact the oil markets?
Geopolitical stability, it's impacting the oil market in the sense that it can disrupt oil supplies and oil flows from producers to consumers, but also on the political sense is impacting the economic outlook and in turn oil demand. So this is obviously something that we're paying very close attention to.
Now, I think it makes sense for us to just think a little bit more about the situation today. So could you explain just how integral the Middle East region is to global oil supplies today? So what do the numbers tell us?
The Middle East has always played a key role in global oil markets due to its abundant low-cost resources. Today, it accounts for 30% of world oil production and 30% of global oil trade. 17 million barrels a day of crude oil is exported from the region every day, and 5 million barrels a day of refined oil products.
So let's step back and talk about some of the information the IEA publishes about oil. So your team produces two reports. There's the monthly report about what's happening today and your annual report that gives a medium-term outlook. So could you give us an overview of the data you're looking at and the sort of forecasts you make?
In our short-term monthly oil market report, we look at the demand for oil by country, by product, by sectors. For supply, we look at the production of crude oil, gas liquids, biofuels on a country level, by projects, offshore, onshore. We're looking at refinery activity, how to transform the crude oil into refined products, and how the trade between the producing countries and the consuming countries are evolving. We're also looking at inventory developments. It's a good indicator on the state of the market, the balance between oil demand and oil supply. And of course, we're looking at the prices for oil products globally.
Now let's move to the big levers that drive oil markets. And it comes down to expectations for supply and demand. So what do you expect to see this year in 2025? And how do you think that can evolve towards 2030? So let's start with demand.
We're expecting oil demand growth of around 700,000 barrels a day this year, pretty much in line with what we saw last year and what we're expecting next year. We're seeing contraction in major economies, including in China, but also in the United States. On the supply side, we're seeing quite robust oil production growth. In the latest month, oil production was up 1.8 million barrels a day compared to a year ago. So this is creating for a quite comfortably supplied oil market at the current moment.
Now, it feels like we're not really going to be able to understand supply and demand without looking at the role of the two largest economies, United States and China. So perhaps you could explain how that looks today and how it's evolved over the last decade.
Over the past decade, we've seen oil supply growth being driven by the Americas and first and foremost the United States. From 2015 to 2024, the U.S. alone accounted for 90% of global oil supply increase on a net basis. U.S. oil production increased by 8 million barrels a day to 20 million barrels a day, positioning it as the largest producer globally and transforming the United States from the world's biggest importer to a net exporter. On the demand side, we saw a similar picture where demand growth was very much dominated by developments in China. Chinese oil demand increased by 6 million barrels a day, 60% of the global total. And moving forward, we're seeing changes to both these both on demand and supply, and quite a different picture.
The IEA forecasts that oil demand in China could peak by 2027. I wonder if you could tell us a bit more about that.
It's true that we now expect Chinese oil demand to peak this decade, with oil demand in 2030 roughly at the same level as we saw in 2024, around 16.7 million barrels a day. And over this period from now to 2030, we do expect continued increases in petrochemical demand of about 1 million barrels a day, offsetting declines in transport fuels. And importantly, we have reduced our outlook for Chinese oil demand growth for 2030 by about 1 million barrels a day compared to a year ago. And that's because of the extraordinary surge in electric vehicles sales that we're seeing in China, comfortably surpassing earlier expectations. So that means that gasoline use in the country has already peaked. And with other forms of substitutions, we see increased use of high-speed rail, we see LNG in trucking, and a slowdown in China's construction sector. We believe that China's fuel oil demand likely already peaked in 2021. So this is a major change for what we've seen in the past decade. In the coming years then, so while Chinese oil demand growth is slowing, it's the other Asian economies that will pick up the pace. The largest source of growth will come from India. But the other economies in Southeast Asia, the so-called Tiger Cups, led by Indonesia, but also Vietnam, Malaysia, Thailand, and Philippines, continue to see strong growth in oil demand, and altogether adding about 2 million barrels a day of demand from now to 2030.
Another one of the big trends seems to be that oil production is rising and oil demand is also still rising, albeit at a slower rate. So are we still expecting oil demand to reach a peak by 2030, something the IEA has said in the past?
Indeed, we still expect to see oil demand peak towards the end of this decade, or rather reach a plateau given the current policy settings. So oil demand growth in our forecast is expected to slow from around 700,000 barrels a day this year and next to just a trickle towards the end of the decade, and a small decline by 2030. But overall, from now to the end of the decade, we do see an increase of about 2.5 million barrels a day of oil demand. Factors limiting this growth, it's subpar economic growth. That's weighed down by trade tensions and fiscal imbalances, but also the accelerating substitution away from oil. As for supply, we're seeing oil production capacity increase by about 5 million barrels a day, so twice the amount of oil demand, mirroring the trends that we're seeing on demand. The supply growth is heavily front-loaded, so slipping from about 1.8 million barrels a day this year to a small contraction by the end of the decade as the pipeline of projects that have already been approved deteriorates.
Okay, so we've spoken a bit about the regional pictures and how that's changed over the last decade or so, but I'd like to know about some of the sectors, some of the technologies that are changing that dynamic between supply and demand. So what are some of the technologies that are pulling down oil demand, whether that's electric vehicles, other fuels, or what are some of the key levers that we're seeing?
On a global level, one of the main factors pulling down oil demand is electric vehicles. AVs are set to displace about 5.5 million barrels a day of oil demand by 2030. That's up from just over 1 million barrels a day in 2024. And this year, we expect EV sales to exceed 20 million. And that's 25% of all cars sold globally. So this is having a major impact. Another area where we're seeing significant changes is in the use of oil for power generation. In the Middle East, crude oil, fuel oil, gas oil is being burned to produce power. And last year, about 1.7 million barrels a day was used to generate electricity. And now we're seeing a major shift in this area where a number of countries are scaling up deployment of renewables, but also using increasingly gas to generate electricity. So we're expecting the single largest decline in oil demand will come from power generation in the Middle East and led by Saudi Arabia. About 1 million barrels a day decline from now to the end of the decade. Finally, behavioral changes will continue to impact oil consumptions. The COVID pandemic led to a significant increase in remote working, teleworking, and that has continued in a number of countries. So we estimate also that about 1 million barrels a day of oil use is saved as people will continue to work from home through the end of the decade.
And on the other hand, what are the big sectors still pushing up oil demand?
As the road transport and power generation sector continue to transition to cleaner fuels, the main sources of growth will be the petrochemical industry, but also in aviation. Oil demand from petrochemical sector will increase by much more than 2 million barrels a day from now to 2030.
And would you mind just explaining a bit about what petrochemicals are?
Petrochemicals are produced from oil products, so mainly naphtha, LPG, and ethane, and they're primarily used to make plastic and synthetic fibers. So this kind of oil use has grown over the past decades, a rising demand for consumer packaging, and manufacturing, construction, and most of the growth has taken place in emerging markets where you're seeing average incomes and urbanization boosting demand for end-user product. And what we're seeing is that plastic are not subject to substitution and efficiency impacts that we're seeing reducing demand in the transport sector. So they're more resilient and the single largest source of growth for demand in the medium term. Also closely linked to growing production of natural gas liquids and this growth both from the Middle East and United States, where we're also seeing petrochemical demand increasing quite strongly.
Let's move now to talk about investment. Firstly, what do we know about the amount of money being invested in oil, in the oil markets today, and how could this affect oil markets at the end of the decade?
We're seeing, as oil prices declined at the start of this year below $60, we saw a number of oil companies scaling back their investment plan for this year. So now our expectations based on the latest updates from the industry is that upstream investment in the oil will decline by about 5 or 6% to $420 billion US.
And as far as I understand it, upstream is the exploration and production side of the industry. Is that right?
That's right. Oil producers are obviously looking at the price of oil when they're determining whether to go ahead with a new project or new drilling campaigns for oil and gas. So when we're seeing fluctuation in prices, especially to the downside, prices fall below a threshold, we're seeing investments being cut back. And when prices increase, you can see increased investment and new projects being put forward for development. But we've done a lot of sensitivity analysis on the U.S. Shale industry, which is the most responsive to changes in oil prices. So if oil prices were $80 over this period, that would result in about 600,000 barrels of additional oil supply growth. And on the other hand, if prices were to fall to $40 a barrel, we would see oil production be more than 1 million barrels a day lower than our base case.
So for decades, there's been a broad picture that GDP and oil demand moved hand in hand. Economic growth meant rising oil demand, but do you believe that will still be the case in 2030?
GDP will continue to be a key driver of oil demand growth, but the relationship is shifting. With the significant increase in clean energy technology deployment, we're seeing the link between economic growth and oil demand changing. The key thing to remember is how interconnected the oil market is. EV adoption in China affects refinery plants in Europe. Shale investment in the US affects Chinese-Saudi strategy. You cannot just look at one piece in isolation. Understanding the links crucial for seeing the bigger picture of global energy and oil market security.
We're in a world at the moment where oil supply is higher than oil demand. Now, does that necessarily mean that we have greater energy security and stability? Does it necessarily mean we have more resilience to some of the oil shocks we've seen in the past? Or is the situation more complicated than that?
I would definitely say the situation is more complicated than that. But if supply exceeds demand for an extended period of time, we will see inventories increase that can help create a buffer against supply disruptions or unexpected boost in oil demand. And the IEA was set up in 1974. One of its core mandates was to establish an emergency response mechanism and strategic oil stocks that can help mitigate supply disruptions and to minimize economic harm from disruptions to the flow of oil.
Well, Toril Bosoni, thank you very much for joining us.
Thank you.